Dr. Babasaheb Ambedkar Open University.
Hello dear friends, welcome again. So here we were already starting our discussions in the last video lectures regarding the financial statements. In the first part of the financial statement series, we were discussing how the financial statements prepared, what are the importance of the financial statements, main objectives, characteristics and other things we were already discussed, right? And in the financial statements, which are the statements to be prepared, like a trading account, profit and loss account and balance sheet. So two accounts and one statements, these are the three main important statements and accounts are supposed to be prepared in financial statements. Here now we are going to discuss in the second part of this financial statements series of lectures, like that is income statements we are going to discuss. And income statements precisely we will discuss two important accounts. One is trading account and the second is profit and loss account. So let's see which are the main points to be discussed in this particular unit. First is introduction of the income statements, core objectives of the income statements. It is already partly discussed in the previous lecture, but still we are going to discuss in the case of context of the precisely of income statements. Specimen of the trading account, so which items to be recorded in the trading accounts, then items included in trading accounts with the part of the informations which way the trading account reflects, and we'll see how practically it will be recorded in the trading account. The same way we will try to find out the specimen of the profit and loss account along with the specimen items, then the difference between the trading account and profit and loss account, and at last we will try to explain profit and loss account one illustration also. So let's begin with the introduction of the income statements. Introduction of the income statements, it shows the financial performance metric, correct? Ultimately it's financial statements metrics to be disclosed through this particular income statements. How it will be showing? So ultimately it's showing purchases, sales, opening stocks, closing stocks, maybe purchase expenses. Through these evaluations will identify the gross profit, and then gradually it moves operating expenses, administrative expenses, selling expenses. All financial transactions will be recorded in this particular income statements account, like revenues and expenses, and at a part of a result we'll find out the profit or loss at the end of the specific accounting period. It's a two-part structure, correct? It's two-part structure. First part is trading account and the second part is profit and loss account. As I mentioned, the trading account information is only related to the trading of the business. So it means that purchases and sales, opening stock and closing stock, or moreover that only the purchase expenses would be included in this particular trading account. At the end of the trading account, when you finish to record all this such financial metrics in this particular account, at the end we will find out the gross profit or gross loss from the particular account. Then the second part of the structure is profit and loss account. Once you find out the gross profit and gross loss, carry forward into the profit and loss account, and then applied all the administrative expenses like an operating expenses, selling and distribution expenses, cash expenses, non-cash expenses, or any kind of a banking, non-banking expenses. At the end of the profit and loss account, we would be able to get the correct information of the net profit and net loss at end. So that's two-part structure, and that is operational assessment, correct? Ultimately income statement is actually a picture of operational efficiency. So ultimately the business is working in the different category, where we just wanted to know, once we already start the business, then establish the business, then we'll start the activity of the business. When you start the activity of the business, you just wanted to know that what is your operational activity, and after the operational activities, what is your real picture. So ultimately we need to assess the things of the operational efficiency of the business as well as the operational activity evaluation. So that operational evaluations can be done through this particular item. and when we were actually having all financial metrics in this particular accounts, we would be able to know the real picture of the business through this particular evaluation. So enables owners, managers and creditors are to evaluate operational efficiency and the earning capacity of the business. Now, core objectives of the income statements. Core objectives are three. One is determine a profitability. Again, these are the objectives of financial statements, but specifically here it is to be discussed for an income statements. So main objective of the income statements are to get the exact evaluation of the profit and loss. So that means the profitability evaluation is there. So first is through trading account we will be able to know that the gross profit and gross loss, and through profit and loss account we would be able to get the net profit and net loss. So that is the first possibility. Second is cost and expenses control, definitely, because of there are so many expenses are there. So ultimately we just want to understand that the expenses which are directly related to the manufacturing, it will be recorded into the trading account. If it is directly concerned with the manufacturing, or maybe it is directly related to the service of the business, then it would be considered to the trading account. But in case of if it is an indirect expenses which are not directly related with the activity of the business, it is to be recorded in the profit and loss account. That is administrative and selling expenses or other cash and non-cash expenses which are indirectly related with the business. So that is to be identified, and after the identification of those expenses, then we need to understand the how we can control such expenses which are over spending or maybe it is above the estimation. So how it can be controlled. So that is you can get the information through the income statement, as well as you can try to control such expenses also. Then the decisions and tax supports, correct. We need to identify the certain decisions to be taken. One, the decision you can actually identify of a fixation of the price, sales price of the product or a sales price of the services also. Then second, you can take a decision of the how much amount of tax liabilities to be paid according to the profitability. And third, you can actually evaluate is there any surplus after all the expenses to be deducted. If you have any kind of surpluses, then the what amount of interest on capital to be paid to the owners, or maybe a salary to be paid to the owners. Or you can take a further decisions that any expenses which are actually above the estimation limit, how it can be controlled also. The such things actually you can take a decision from the financial statements which are already prepared. Yes, this is the part, important part. Here this is a specimen of a trading account. So as I mentioned in the previous lecture, when you are preparing a trading account, it is always prepared for the year ending. So why it is for the year ending? One, actually this is an account. Second, this is actually a summary of the overall transactions throughout the year is actually occurred. So all the year transactions were actually find out the summary, and that summary has to be recorded here to find out the gross profit and gross loss. So now how it would be recorded? See, any kind of purchases, whether it's a cash purchase or a credit purchase, all purchases will be recorded here. So all purchases are recording here, whether it's a cash purchase or a credit purchase. Along with any kind of purchase returns are there, then purchase return would be deducted from the purchase, and the net purchase will be recorded in outer column. After the purchases, you are going to have some sales also. So sales would be recorded on the other side, that is credit side. This is debit, this is credit. All expenses and purchases are debit, all incomes and sales are always credit. So the sales minus sales return, whether it's a cash sales or a credit sales, all sales are recorded here minus sales return. The net sales will be recorded in outer column. Now, after the purchase and sales, the difference between this opening purchase or purchases and sales, if the purchases are higher than the sales, at the end some goods were unsold, it is considered a closing stock. So that closing stock also recorded in the trading account credit side. Closing stock, it means the goods unsold, which is also a considered part of your assets. So it will be increasing your valuation of profit, not now, but maybe in the next year when it will be sold out. So closing stock would be also recorded in the trading account credit side. The current year closing stock is always an opening stock in the next year. Correct. So opening stock always to be showing in the trading account debit side. So here it was an opening stock. This is to be showing in the trading account debit. It is actually a closing stock of the last year. That's why it's considered here as an opening stock of the current year. Now any direct expenses, production wages or a direct wages or a direct expenses always recorded in the trading account debit side. Direct expenses of the raw material converted into a ready material or a finished goods, or maybe the expenses which are directly connected with the purchases, all things will be recorded here, whether it's a direct wages, productive wages, carriage inward, freight, cartage, dock charges, port charges, any damage which were actually damage were charged by the port trust and other things, wharfage, factory expenses, rent, gas, fuel, power. Even factory expenses is also considered trading debit. Why? Because of factory expenses is directly related with the manufacturing of the goods. So that's why the factory expenses is also here. Any kind of a depreciation related to the factory assets is also considered into the trading account debit side. So these are the items to be recorded in the trading account debit side. Here the sales is already recorded, closing stock is already recorded. Any kind of a sale of a scrap of goods, so that scrap goods is also, it's part of your income recorded here. Or one more item, any sales other than the sales which are not considered, but any goods goes out other than sales, goods goes out by other than sales which are not considered under the sales, but maybe the goods goes out by burned by fire, goods goes out by theft, goods goes out by any other reason would be considered. But there are two possibilities, that one you can record it either maybe on the credit side or it would be deducted from the purchase. So that both the things can be possible. And at the end of all this, now you have to make a total of both the side and just need to identify where is the shortage. So which side is the total is higher, the deficit would be recorded on the other side. So in case of if the credit side total is higher than the debit side, the deficit will be written here. That is considered a gross profit. Why? Because of the credit is higher. But in case of if the debit is higher than the credit side, then the deficit will be written here, which is considered as a gross loss. This gross loss and gross profit will be transferred into the profit and loss account. So in case of a gross loss, it will be transferred into the second part of the structure, profit and loss account, debit side. So to gross loss bracket balance brought forward from the trading account. Or in case of a gross profit, it will be transferred into the profit and loss account, credit side, by gross profit bracket transfer from the trading account. So this is the specimen of a trading account. Now moving to the next point. So I think I already discussed everything. Opening stock, it's value of unsold goods brought forward from the previous year that I already mentioned. Closing stock, unsold inventory at the end of the current accounting year, which is recorded in the trading account credit side. Net sales, gross sales, whether it's a cash and credit minus sales return. The same way purchases, total purchases, credit and cash purchases minus purchase return. Correct? Then sale of scrap, income generated from any selling goods of the scrap goods or any goods, it will be considered the credit item. Carriage, freight and direct wages and factory expenses would be debited. And the valuation rule, that closing stock is always, it's very important, closing stock always valued at cost price or net realization value, whichever is lower. Correct? So closing stock recorded in the books of accounts, the comparison between the actual price or the market value, whichever is less, that would be recorded in the books of accounts. Next point, practical illustration, very simple way, but just try to record this. The trading account we are preparing, it is the title of the trading account is we are preparing a trading account in the books of Mukesh for the year 25-26. So you can write here, the title is Trading Account of Mukesh for the year ending 31st March 2026. Particular amount, this left is debit, right is credit. Start with this first item, opening stock 80,000. So opening stock always showing in the trading account debit side, two opening stock, 1/4/2025, 80,000. The next item is purchases. Purchase is 3,28,000. Purchase return is 20,000. So we have to record purchase, net purchase outer column. So purchase is 328 minus return 20,000. Outer column is 3,08,000. Next is sales 4,40,000 minus sales return 40,000. So it will be recorded in the trading account credit side. Sales is 4,40,000 minus sales return 40,000. Net amount is 4 lakh. Next, wages 20,000. Wages is an expense. So trading debit, wages 20,000. Freight 16,000. Freight is again expense. Trading debit 16,000. Then the carriage inward is also, it's an expense, but it's a purchase expense. So carriage inward trading debit 4,000. Closing stock 88,000. Market value 1 lakh. I already mentioned in the previous slide, the closing stock is always valued in the books of accounts, market value and the book value, whichever is less. So here the 88,000 is the closing value, that is the book value, and 1 lakh is the market value, but the lower price is 88,000. So we have to record closing stock at the lower price 88,000 in the books of accounts. So this is the way to record the entries in the trading account. Now we'll make a total of both the side, and we identified that the total of the credit is higher than the debit. So 4,88,000 rupees total write down on the both the sides 488, where the deficit amounts is actually 60,000. The deficit on the debit side, it is considered a gross profit. Because of the credit is higher than the debit, so the difference is gross profit. It is to be transferred into the profit and loss account. Here it is written transfer into the profit and loss account 60,000. In P&L account credit side, by gross profit bracket transfer from trading account. Okay, now this is a specimen of profit and loss account. Again we have to write the profit and loss account of so and so, Sri so and so, same title for the year ending. We are also preparing trading and P&L both the accounts for the year ending on 31st March or whatsoever it is. Correct. Now first item is the gross profit and gross loss that has to be brought forward from the trading account. In case of a gross loss, it will be write down in the P&L account debit side to gross loss bracket brought forward from the trading account amount here. And in case of a gross profit, it will be write down in the profit and loss account credit side, that is by gross profit brought forward from the trading account amount. Now all administrative expenses, office expenses, start with these administrative office expenses, whether it's a salary, rent, insurance, printing, audit fees, etc. All these expenses, administrative expenses are going to write, and the amount is outer column. Then the next is selling expenses, all kind of carriage outward. Carriage inward is recorded in trading account, but carriage outward is recorded in profit and loss account, salesman's salary and advertisement expense, packing expenses. So all selling and distribution expenses will be write down and then outer column. Financial expenses, interest on capital, bank charges, other interest recorded here on this account. Then the other losses, or you can consider as a non-cash items, non-cash expenses like depreciation, the bad debts loss due to a fire, theft, it's considered as a loss or maybe a non-cash item. That it will be recorded in the profit and loss account debit side. Here on the credit side, any income other than the sales, normal incomes like a discount, rent, commission received will be showing in the profit and loss account debit side. Interest on investments will be recorded on the credit side. Suppose if any owner was actually withdraw the amount from the business and the firm is charging interest on drawings, then interest on drawings is also income for the enterprise or a business considered as income. Bad debts recovered, asset sales on profit. So these are the incomes. Bad debts recovered, it means already bad debts as an expense, it was debited in the profit and loss account earlier. Now that write off bad debts has been recovered, so that is your income. That's why it's bad debt recovered, it's showing as an income. And the profit on sale of assets. So if you sell any assets and you earn a profit, would be also considered as an income. Apprentice premium and miscellaneous income. Apprentice premium, if you are actually having any kind of a person working in your firm where you are charging some premium, apprentice would be considered as an income. At end, we are going to close this profit and loss account and find out the net profit and net loss. So in case of the total of the credit is higher than the debit, the difference is considered as a net profit. Then it will be written here on the profit and loss account debit side to net profit into bracket transfer to the balance sheet in capital account. So that is net profit transfer into the balance sheet in capital account. And in case of a net loss, again it will be write down on the credit side because of the debit is higher. So that any kind of loss by net loss bracket transfer to the balance sheet in capital account. In case of profit in balance sheet, it will be added into a capital. In case of a loss, it will be deducted from the capital. So this is your specimen of the profit and loss account. Now moving to the next point, it is a difference between the trading account and profit and loss account. Now we'll see how this trading account and profit and loss account is slightly differ each other. Here the first is primary objective, determines the gross profit and gross loss from direct buying and selling, or you can say from the direct trading. Ultimately the company who are actually doing a trading of the main business, they just wanted to know that what is the first prima condition of the company on the initial level or after the first phase of the process of the company or enterprise. So first process is after buying and selling of the product or providing a services, they just wanted to know that any kind of a profit earn or loss after the initial services. So that is actually a trading account's objective is to identify gross profit or gross loss from the trading of the business, where profit and loss account's main object is to determine the net profit or net loss after the all operating position, after the operational position or operational activity. Company or enterprise willing to know that what is your end positions after the operational activity. Sequence: prepared first immediately after the trial balance. Correct. Trial balance, once you prepare trial balance, your trial balance is already matched, then start the trial balance is always the first item is prepared, the trading account. So that is sequence, and this is actually prepared the second item after the trading account. We need to prepare the profit and loss account, or you can say the sometime you are preparing together also simultaneously, but the trading account information is always reflect first. Why? Because of before you identify the gross profit and gross loss, you cannot move further to identify the net profit. So that's why it's considered the first is trading, then P&L, and then it will be a balance sheet, because of first you were identified the gross profit and gross loss, then net profit and net loss, and then you will actually find the closing capital at the end, and then the balance sheet total will be identified. Expenses type: only the direct expenses like factory expenses and carriage inward and other things, or a purchase sales will be recorded in the trading account, where only operational expenses, indirect expenses or non-operational expenses recorded in the profit and loss account. Income types includes the direct incomes. Direct income means the trading income. Only those income will be considered here which are recorded in trading account, which is called the direct income. Direct income means the only trading income of the company's main object of the business would be rectified and would be justified through the trading account. So, main object of the business is to earn a profit or loss from their business activity. So, whatever the situation will arise, it would be reflected through the trading account, that is called sales. And here the any indirect incomes like received commission, received rent, received brokerage, received any other part of interest and rent would be considered indirect income that will be entertained into the profit and loss account. Starting point is always opening stock and purchases. Generally it starts with the opening stock and purchases because of opening stock is the beginning of the trading account. So, we need to identify the opening stock and then purchase, and then gradually the other items of the trading account would be considered. Here the starting point is gross profit or gross loss we need to transfer first in the profit and loss account, and then we will write down all the remaining transactions from the trial balance into the profit and loss accounts. Result transfer, generally gross profit and gross loss balance is transferred to P&L account, and the net profit and net loss will be transferred into the balance sheet and added into the capital or deducted from the capital account. So, this is the major differences of trading and P&L. Now, this is your practical problem of profit and loss account. Here we are preparing a profit and loss account, Dhaval's books, and the date is 31st March 2026. So, profit and loss account of Dhaval for the year ending 31st March 2026. The title debit and credit. Now, we will see the item. The first item is gross profit. So, first item is gross profit. As we already discussed, the gross profit is your credit item. So, first starting with by gross profit 95,000. Second item is discount received. REC it means received, short form. 5,200 discount received, it is an income. So, income would be considered here as an income, P&L account credit side. Then carriage outward is an expense. Carriage inward is also expense and carriage outward is also expense, but one will be recorded in trading account. Carriage inward recorded in trading account, but carriage outward is recorded in it is in P&L account. There is a difference. Carriage inward, it means when you purchase the goods, then you paid any carriage to the transportation charges or anything, that is a purchase expense. That's why it's carriage inward is recorded in trading account. Carriage outward means when you sell the goods, and paid any transportation or any other expenses to the for the concern, that's sales expense. That's why it's considered in P&L account debit side. Postage, it's an administrative expense. So, carriage outward, postage, both are profit and loss account debit side. Commission received is again income. So, commission received income, P&L account debit side. Then salary expense, salary P&L debit. Miscellaneous expenses, again miscellaneous expenses, it is a expense, P&L account debit side. Insurance, it's not mentioned here, but it is always expense only. So, insurance premium, profit and loss account debit. Office expenses, again it's considered expense. So, P&L account debit. Discount allowed, discount received and discount allowed. Discount received is income and discount allowed, it's an expense. So, discount allowed expense debit. Interest received is your income. So, interest received, it's profit and loss account credit side. Loss by fire, that's your loss, that's why profit and loss account debit. Bad debts, it's a non-cash item. Actually, we are not having any kind of cash goes out and cash received, but bad debts, it's a non-cash item, it's an expense. So, it's profit and loss account debit. Bank charges, again it's a debit because of the charges debited by the bank in our account. So, it's an expense, bank charges debit. Traveling expenses, it's an expense, selling and distribution kind of expense, but it's an expense. So, it's trading account debit side. Advertisement expense, again selling and distribution expenses, but expenses, that's why it's debit. All transactions were already recorded in the profit and loss account. So, now here all these informations were recorded in P&L account. We need to close down P&L account. We have to make a total of profit and loss account credit side and debit side. Just need to identify which side is higher. So, here the total of the credit is 1,07,000 and the total of the debit must be lower than that, and that's why we just need to find out the difference. The difference is actually on the debit side, the deficit on the debit side. That's why it's considered the net profit. So credit side total is higher than the debit, and that difference is 68,000. So that's why it's considered the net profit, which is to be transferred to balance sheet and added into the capital. So transfer into balance sheet capital account, that is 68,000. So this is the way to prepare the profit and loss account. I think you are able to understand that how the trading account and profit and loss account is prepared, what are the basic difference between the trading and profit and loss account, and how the gross profit and net profit will be treated in the particular account, and what are the importance of the trading and P&L, that I also explained with you. I hope you might understand all these things. Thank you so much.